Moving average. Probably one of the most effective indicators. It can tell you where the market is going, what's the best entry point, and where to exit. But most traders use it the wrong way. They intermix multiple moving averages to the point that their chart looks something like this. I don't know how anyone can differentiate between slow and fast moving averages. So let me show you the right way to use moving averages. The best way to use this indicator is adopting the crossover strategy. Now, what does it mean? Let me explain. A moving average crossover is basically a method in which we use two moving average indicators, one that's short-term and another that's long-term. Whenever these two averages cross each other, it signals a possible change in trend direction. Unlike most indicators, this strategy doesn't try to predict the future. Instead, the crossover only happens after the price has already started moving in a new direction, giving clear, rule-based signals and removing much of the guesswork and emotion from trading. But most traders seek shortcuts and fail miserably. As soon as they see that the short-term moving average line crosses above the long-term line, they take a buy trade. And the moment it crosses below, they take a sell trade and enter a short position there. They believe the crossover strategy is just a hard and fast rule for taking positions. And this is exactly why most of their trades end in losses, and they end up claiming that the strategy doesn't work. But in reality, they never understood the core concept and instead chose shortcuts, which later leads them to make mistakes that destroy their accounts. So here are 3 mistakes you should avoid while adopting the moving average crossover strategy. Mistake number 1. Placing trades in a choppy market. I get it. For most traders, the crossover strategy is just buy and sell signals. But in a choppy market like this, you must not use the crossover strategy. Because here, in a ranging market, the lines keep crossing back and forth, generating signal after signal. But the price is just bouncing within a range. Every crossover you try to trade will lose you money. If you blindly follow this strategy with your eyes closed, the chances of your account becoming empty are 100%. The crossover strategy doesn't work in ranging markets, and markets spend roughly 70% of their time ranging. That's why you need to identify trending markets first. Mistake number 2. Seeking crossovers on lower time frames. Many people set lower time frames like 5-minute or 15-minute and use more than one moving average because they believe it increases the chances of taking a good trade. But here's the reality. On lower time frames, moving averages start giving a lot of false signals, especially when the market is consolidating, or when the market is very volatile and price is swinging up and down. The crossovers happen so frequently that you can't tell which ones are real trend changes and which ones are just noise. You end up taking trade after trade, only to get stopped out repeatedly. Mistake number 3. Ignoring the lag. No matter what you do, moving averages always lag behind. Which means, in a market like this, price moves first and the indicator moves later. Moving average is a trend-following indicator, which can only tell you the direction when the trend has already started. You can never know from moving averages when a new trend will start because it's a lagging indicator. Look at this chart. When the candles show an uptrend, the moving average kept moving sideways and only showed an upward slope after a few candles have already formed. This shows that price moves first and moving average follows after. These 3 mistakes are exactly why most traders fail with crossovers. But now that you know what not to do, let me show you what actually works. Here's the step-by-step method to trade crossovers the right way. Step 1. Start with only 2 moving averages. First things first, keep your chart as clean as possible, because as they say, charts represent your mind. If your chart is cluttered with 3, 4, sometimes 5 moving averages, you'll overcomplicate crossovers and make the wrong moves. So stick to using just 2 moving averages. Let's use the 20 EMA and 60 EMA. The 20-period moving average reacts to recent price movement. It moves quickly and shows you what's happening right now. The 60-period moves slower and gives you the bigger picture of the overall trend. When these two interact, you get a clean view of momentum shifting from one direction to another. You need to understand that this entire setup you see here is not meant to predict tops or bottoms. It only tells you when a price has already started moving in a particular direction, so you can take a buy or sell position. If you expect it to catch the exact candlestick where the trend will start, you'll be frustrated, because this is not what moving average crossovers are designed to do. Now, let's move on to step 2. Use a higher time frame. As I said earlier, moving average doesn't work on lower time frames, so you have to keep it higher. The 24 hours chart is the sweet spot. It smooths out all the random price movements and gives you crossovers that actually mean something. When you see a crossover on the daily chart, it represents days of price action coming together to signal a momentum shift. If the daily feels too slow for you, The 1-hour chart is the lowest you should go. Anything below that and price moves too fast. You'll see crossovers happening left and right, but most of them lead nowhere. Moreover, higher time frames give the moving averages enough data to actually represent market direction. On a 5-minute chart, a moving average is just reacting to every tiny fluctuation. On a daily chart, it's showing you genuine momentum. Sometimes you need more data to prove whether the crossovers actually work or not. For that, you need to do this third step. Select the right market. This is something most people never even think to check and fail badly. You need to understand that moving average crossovers don't work in every market. Some markets respect moving averages and trends as per its signals. Others chop around and ignore them completely. If you apply the same crossover rules everywhere, you'll destroy your account. So before looking for a crossover signal, you have to check whether the stock or market you are trading in respects crossovers or not. For that, you need to select your stocks and zoom out to look at least 6 to 12 months of data. You have to find 2 simple answers from this data. When these lines crossed in the past, did price actually move in that direction, or did it ignore the signal? If price tends to trend after crossovers and respects the moving averages as support or resistance along the way, that market is worth trading. If price constantly cuts through the moving averages and goes nowhere after crossovers, skip that market entirely. This one habit alone filters out most losing trades before you even enter them, which leads me to step 4. Enter the trade the right way. Now, we have set the time frame, tested the market, it's time to enter the trade. Look at this chart closely because this is where most traders get it wrong. Here you can see multiple crossovers, but not all of them are tradable. Only 2 crossovers are buy signals. The ideal entry appears around this region where the 20 exponential moving average crosses upward through the 60 exponential moving average, and the very next bullish candle closes above both moving averages. Here the momentum has already changed, price has confirmed the direction, and it's becoming a bullish trend. It's the ideal buying point. So the early ideal entry is the first bullish candle, close after the 20 EMA crosses above the 60 EMA, with price cleanly above both lines. Remember, one high-quality entry near this zone is worth more than 3 late entries near this region. Step 5. Take quick exits. The ideal exit does not happen at the top. It happens when momentum fades. On this chart, that signal appears just a few candles later when price starts closing below the 20 EMA and the moving average flattens out. That first bearish close below the 20 EMA in this zone is the ideal exit. Here, the trend is no longer accelerating and the edge is gone. There's one more way you use the moving average crossover strategy. Treat it like dynamic support and resistance instead of just a buy or sell trigger. When price keeps reacting at the same moving average level, bouncing off it multiple times, that average is clearly being respected by the market. If price repeatedly moves up into the moving average and gets rejected, that level is acting as resistance. If price drops into it and bounces, it is acting as support. This becomes more powerful when you add the stochastic indicator for confirmation. When price reaches moving average resistance while stochastic is overbought, reversals tend to happen more often. The same logic applies to support when stochastic is oversold. Now, let's take a short recap of what we've discussed in this video. Moving average crossover can win you trades only if you apply 2 moving averages, higher time frames, and markets that respect crossovers. And then, take early entries and smart exits. Most traders overcomplicate this and lose. You don't have to be one of them. If you find this video helpful, subscribe to our channel and I'll see you in the next one.